Market outlook: interest rates are going to stay low for longer, and that's been we've been saying that for ages. Bill Evans, I have a lot of respect for, has called it very well this cycle. He's basically saying another 2 years at 1.5%. Maybe had some inside information because Westpac actually raised rates out of cycle, and that was one of his reasons why rates don't need to be raised by the RBA, because the banks will do it for them. Which means term deposits are getting you bugger all after inflation. You're basically getting maybe $5,000 on $1 million term deposit if you allow for inflation, which is nothing and never going to satisfy retirement. Hence, there is a strong place for income for something like PL8 in a client's portfolio, because Australian shares, where else are you going to get 6% income out of the index, or in our case over 8%, and the underlying fund has actually delivered almost 9%. It invested in an underlying fund. It is currently now delivering over 8% income, the PL8, and that might tick up a little bit over time. It's also happy to say that not only is it now delivering regular monthly income, which is one of its objectives, but it also has actually outperformed the market over the last 12 months, which is pretty good, because ever since we listed that fund, it's been probably the worst possible time for income stocks. Telstra, the banks, they've all been hammered, and for us to actually perform in line or with the market, indeed just above it over the last 12 months, is pretty reasonable. We're not going to say it's a great result, but it's better than if your clients are in Telstra and the banks. It is the only LIC paying monthly dividends. We are now paying 0.5 cent cash, fully franked dividend at 30 cents, a 30% franking rate per month. We started with 0.45 cents a share and then raised that after 6 months. Actually now paid 13 monthly dividends, with 2 more already announced for the end of this month and end of December. If you annualise the 0.5 cent a share fully franked, it actually works out currently to, well, as of last week, it's probably down a little more, but about 8.4% gross yield. From performance point of view, it was an incredibly tough time, and also, I mean, clearly the market's come off rapidly. So if I was doing this presentation a month ago, those numbers on year were 15%, and suddenly the market's down, the base has changed, and it's like 4%. Happy to say we're a tad ahead, albeit it's very little, but we're at least ahead of that benchmark over the last 12 months, and delivering more income along the way. The share price has been a bit challenged, particularly, and this is Lisa talked about the ALP policy. PL8 traded pretty comfortably above NTA until one thing happened, which is in March this year, the ALP announced the policy of, potentially stopping franking credit refunds for certain investors, not all investors, but certain investors. So charities and pensioners are still fine, but self-managed super funds and self-funded retirees may be in trouble, but it has to get through. But that's when it started trading at a discount. And interestingly, it now seems to me that it's almost trading as a defensive stock on yield, and it doesn't seem to move much with the market. So we were quite bewildered that when the market did rise rapidly and the NTA of the fund rose rapidly in July, August this year, that our PL8 did nothing. But we're very happy to say that when the market fell, it did nothing as well. So basically, it's now back to NTA. So it does seem to be almost trading as a low beta stock with now a handsome yield. I don't really need to go too much into the toughness of the period, but I think this slide highlights two things about the Australian market and why PL8 is a better investment than maybe a broad market, or indeed a portfolio of banks and Telstra, because whilst the banks and Telstra provide about half the income of the market, they've absolutely been trashed from a capital point of view. Since listing, this is the history since the listing of PL8. In fact, if you go back 2 years, you've got a similar sort of pattern, even slightly worse. But from a price performance, the big four banks as a whole, which is a light blue line, are about 20% behind the index over 18 months, and Telstra is about 30%. If you go back a bit further, Telstra is even more than that. Yes, you've got some reasonable income off those stocks, but it doesn't make up for those capital falls. So for us to actually have performed pretty much in line with market over that period is reasonable, because we have to play in the banks, we have to pay in the high yield stocks. So it's not like we can't avoid them. There's no way that we can generate 8% or 9% income without investing in those stocks, but our rotation and very active strategy means we're not overweight, but we're getting a lot more income out of them. And overall, people say, market's down, what's going to be effect? Dividends are growing significantly. Nearly 70% of companies increased dividends, and the average reporting season or median increase in dividends was about 6%. The average is actually more than that. We haven't got the bank numbers in here, so obviously the three big banks reported in the last couple of weeks, and none of them increased their dividends, but probably importantly, none of them cut their dividends, which prior to that question I often got from clients was, are the banks going to cut their dividends? And generally said, well, I think, the underlying earnings are pretty solid. The $1.5 billion of write-offs for all the Hayne Commission and legal costs and all that sort of stuff, that's a big number, but let's put it into perspective. They make $30 billion a year. It's a 5-year cost, maybe even 10-year cost, some might argue, because it's all the woes of the last 5 or 6 years being, expensed in 1 year. So actually, if you take $1.5 billion divided by 5 years, it's $300 million a year on a $30 million profit. It's 1% of profits. It's actually pretty meaningless. And I was talking to a senior person in Melbourne yesterday, was sort of like, our bank guy was sort of like, the banks have got off lightly in terms of their core business, which is lending. Yeah, it's a bit here and a bit there, but it's the financial services and the AMPs and those businesses which most of the banks are exiting. And, CommBank got a good price for Colonial GAM. They're exiting those businesses other than my old shop, Westpac. So, very good season. That's sort of history, but so I'll roll on to more recent things. And I think it'll be a bumper year, albeit there from one-offs for dividends for the market and for the Plato PLH/Plato, generating, whether we pay them out or not, it's another matter, but generating income, because Rio did a massive buyback, which completed on Monday. And it's actually only scaled back by 57%, which is a lot less than it has been. For every stock share you successfully tendered in for a tax-exempt investor, it was worth about 17% for that return. Made about 15 basis points for our underlying fund in one hit relative to the benchmark. BHP has announced an even bigger buyback, $7 billion Aussie, $5 billion US, and a further $7 billion special dividend. Now, if you actually collectively look at that, there's something like $14 billion in cash and $6 billion in franking credits going to be released. And of course, on Friday, Woolworths looks like it's finally sold its petrol shops and stations, and there is strong talk that they might do a buyback as well, which is great, because if this franking thing gets in, flush out those, pay out as much franking credits as you are. Not that BHP, Rio and Woolworths are going to be shy of franking, because BHP, on our calculations, will still have about $10 billion in franking credits after paying $6 billion out. So, not counting how many it's generating this year. So it's got a massive thing. So is Rio. Rio's still got excess, and so is Woolworths. Woolworths, even if it did a $1.7 billion buyback, would probably still have over $1 billion excess franking credits. So get them out. And but if all those happen and they actually don't get scaled back as much as so something like Rio, then it may be that we'll have a real cracker sort of amount of cash and the market to buy things with, whether it's buying other stocks or returning to shareholders, etc. We'll have to decide how we PLA distributes that income. Does it boost long-term earnings, or does it actually perhaps pay a special itself to get it out before the franking changes, if that happens? So that's sort of all I want to talk about the market. We don't think cash rate's going anywhere. The outlook for dividends looks pretty strong, and in fact, there's some short-term, albeit one-off, very big payments likely to come in the next few months. Certainly this financial year, which is great timing because the ALP's policies, and it's not just franking, it's CGT and it's negative gearing. The hits just keep coming if they get in, and we need to keep fighting the fight, which means, and interestingly, there is an inquiry, there is a government inquiry, and we put that in. And what they want to hear, and I'm just going to go to 2 slides here, what they want to hear is the people who are really going to get hit, but they don't want to hear about your clients that lose 50 grand worth of franking, because they think if you've got 50 grand of franking, well, you've got a hell of a lot of dividends, so that they don't care. What they want to hear about are the people like, and I use actually a situation close to my very home, which is my mother, who was just a self-funded retiree who had about $30,000 of taxable income, which is pretty much all in fully franked dividends from Australian shares. So if you work that back, someone, if they had no cash or anything like that, she did have a bit, but you would get, say, you have $600,000 invested, you get maybe $30,000 income, including franking. Maybe it's a bit more, or what have you, 500,000. But she would have had income of about $30,000, including franking. Because she isn't a pensioner, she doesn't qualify for that. She had a little bit too much assets. She would actually lose $8,000 worth of franking credits. Her income would fall from $30,000 to $22,000, which is a 28% decline, and she would actually earn less income than the full age pension. Now, you can't tell me that's not someone who's going to really struggle under that sort of thing. Just imagine if everybody here, Morgan says you're going to get your pay cut by 28%, including bonuses. So, bonuses are important, but it's all going to get cut by 28% going forward. You'd be pretty upset. You'd probably go and look for another job. Well, if you're a retiree, and you've been out of the workforce for many years, you can't go back and get another job. So how the hell do you make that up? And that's the issue. And that's what I want to hear from some of your clients who actually aren't that wealthy, but it's a big hit to them personally, and they actually want to hear those stories. That's what we need to bang them out and show the Labor Party there's not necessarily millionaires. It's okay, they might think they're well off because they're self-funded retirees, but for an individual with 600,000 or 700,000 invested, for a couple it's $1 million. They don't get the pension, but they get, if they've got a lot of Australian shares, they're going to have a big hit.